Will we see a massive crypto crash in September? Crypto is heading straight into its most dangerous month of the year. We're just a week away from September, and if history repeats, it could deliver one of the biggest market crashes of this cycle. The crazy part is this is not just some random guess. I mean, every single post-halving year in Bitcoin's history has seen the same pattern. September brings a violent correction, wiping out 20, 30, sometimes even 40% in just a matter of days. Despite the volatility, so far August has been a strong month, but just like in 2013, 2017, and 2021, the setup looks eerily similar. Analysts are already calling it Red September, and even the stock market has the same seasonal weakness. For crypto investors, that means the next few weeks could be critical. In this video, I'm going to break down why September has historically been crypto's danger zone, what actually happened in the last 3 cycles, how deep the crashes went, and how long they lasted. Most importantly, I'll show you what this history means for 2025 and how you can prepare before the next red wave hits. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's get right into it. If there's one month that has consistently haunted Bitcoin investors, it's September. Look across the history of Bitcoin's monthly returns and you'll notice something unusual. Every other month shows mixed performance, sometimes positive, sometimes negative. September is the exception. It stands as the only month with a double negative. Both the average and the median return are in the red. That makes it the weakest month in Bitcoin's entire record. The bigger concern comes from the halving cycles. In every blow-off year, 2013, 2017, and 2021, September triggered a severe correction. And these were not small pullbacks at all. Each one wiped out between 15% and 40% of Bitcoin's value within a 2-week window. Altcoins often fared even worse, with losses that reached as much as half their market value. By late summer, prices usually run hot. Strong rallies across spring and summer feed leverage, greed, and a sense of invulnerability. That leaves the market stretched, and September becomes the breaking point. The crash strikes quickly, shakes confidence, and forces weak hands to sell. But this weakness is not unique to crypto. Decades of S&P 500 data reveal that September is also the worst month for stock. Analysts have labeled it Red September for that reason. When both markets face pressure, the impact compounds. The setup becomes a serious threat to anyone unprepared, and those who ignore history often face painful lessons. To see how this cycle began, we need to go back to the first year September showed its teeth. To understand the pattern, the best place to begin is Bitcoin's first real post-halving cycle in 2013. By the end of that summer, Bitcoin had already gained huge momentum. August delivered a strong rally that left traders convinced the market had endless room to run. On August 31st, the last day of the month, Bitcoin peaked. That timing was not a coincidence. It marked the moment when buying pressure was exhausted and sellers stepped in. The crash that followed carved 15% out of the price in less than 2 weeks. For investors in 2013, this was the first taste of how September could punish. At that time, Bitcoin was still young and few had seen such sudden volatility in a growing bull market. The 15% drawdown looked brutal, especially to early holders who had never experienced a post-halving blow-off cycle. The move shook out confidence, pulled down leverage positions, and created fear that the bull run might already be finished. Yet the drop did not last. By September 9th, the bleeding stopped and the market began to climb again. Anyone who had bought around that date saw gains for the rest of the month. This short, sharp reset fit the rhythm that would later repeat in future cycles. A strong August rally, a sudden top, then a fast 2-week flush that made the market healthier heading into October. 2013 established this outline, and September corrections were not accidents. They were part of a repeating structure that returned stronger in later cycles. Fast forward, that structure came back in 2017, and this time the drop was far more punishing. The cycle repeated 4 years later, but this time the crash was far more severe. In 2017, Bitcoin was no longer a niche asset for early adopters. It was starting to enter the global spotlight, pulling in retail investors and drawing headlines around the world. August once again delivered strong gains, fueling a sense of inevitability in the rally. On September 2nd, Bitcoin reached its top. Within days, the market collapsed. Over the next 13 days, Bitcoin's price fell by almost 40%. The shock was devastating. Traders who had never seen such a deep correction panicked. Margin positions were wiped out, and altcoins fared even worse, with many dropping 50% or more. Social media that had been filled with euphoria in August turned into a wave of fear and disbelief. For many, this was the moment they realized bull markets come with brutal shakeouts designed to punish overconfidence. Yet once again, the pattern showed its second half. By mid-September, Bitcoin had bottomed. The second half of the month brought stability, and by mid-October, the market had erased its losses and was climbing to new highs. Those who sold in fear missed the recovery, while those who bought near the bottom enjoyed one of the best entries of the entire bull run. The 2017 correction proved the September curse was no coincidence. It was not the same as the quick 15% drop in 2013. This time, it was a deep and punishing cut that showed just how violent the market could be when conditions are met. The same rhythm appeared again in 2021, only slightly altered in its timing. The cycle did not end with 2017. 4 years later, September once again brought a sudden correction. By 2021, Bitcoin had grown into a $1 trillion asset with massive institutional attention. August was strong just as it had been in previous cycles, and momentum carried into early September. But instead of topping right at the start of the month, Bitcoin peaked on September 7th. The market then turned sharply, and over the next 2 weeks, the price dropped by about 25%. For traders and investors, the correction was painful, but not as severe as the 40% collapse in 2017. Altcoins still suffered deep losses, often 30% to 40%. Reminding everyone that these downturns punish smaller coins harder than Bitcoin itself. The sell-off liquidated over-leveraged positions, cooled off speculation, and forced weak hands out of the market. Fear spread quickly, with many questioning whether the bull run was already finished. But the recovery once again followed the same script. By the third week of September, Bitcoin found its footing. The final week of the month brought stability, and by October, the market was back on track, pushing to new all-time highs. What looked like disaster in the first half of September turned into another short-lived reset before Bitcoin's biggest surge of that cycle. 3 cycles in a row, the same pattern appeared. A strong August, a September top, and a 2-week correction that cleared the field before the rally continued. By this point, calling it coincidence no longer seemed realistic. The fact that traditional markets also struggle in September only adds weight to the pattern. The September weakness is not limited to Bitcoin. Traditional markets also suffer during this month, which strengthens the case that the pattern is more than just coincidence. Looking at the S&P 500, which represents the broader stock market, the data is clear. Across decades of performance, September stands out as the worst month of the year. Average returns are negative, and the median shows the same result. This is not a single bad year or an anomaly, it is a repeating seasonal effect that investors on Wall Street have tracked for generations. When equities fall, liquidity across the financial system contracts. That pressure spills into risk assets like Bitcoin and accelerates the drawdown. This connection matters because it shows that Bitcoin is not entirely separate from the global economy. Even though it is designed as a sovereign, scarce asset, it still trades within the same cycles of risk appetite as stocks. When investors de-risk in September, they sell not only equities but also crypto. That overlap explains why Bitcoin has consistently followed the same September curse that has haunted the stock market for decades. For crypto holders, this link means September is a double threat. The historical weakness of Bitcoin itself combines with seasonal declines in equities, creating the perfect storm. Altcoins, being more volatile, often experience the worst of it. Recognizing this pattern is one thing, understanding why these crashes occur at the same time every cycle is the next step. Seeing the same September crash repeat across both Bitcoin and stocks naturally raises the question of why it happens. One reason is liquidity. By the end of summer, many institutional investors rebalance their portfolios, closing risk positions and taking profits. That creates selling pressure at a time when trading activity is already thinner, which makes every move sharper. In crypto, where leverage is common, this effect becomes magnified. When prices begin to drop, margin calls accelerate the decline, creating a self-reinforcing cycle. Another reason is psychology. Strong rallies across spring and summer often leave traders feeling overconfident, speculative positions build, greed dominates sentiment, and latecomers enter heavily leveraged trades. September becomes the breaking point because once the market shows weakness, that optimism flips into fear. Investors who expected endless gains rush to exit, triggering cascades of selling that quickly spiral into double-digit losses. Macro policy is another reason. The Federal Reserve and other central banks frequently hold big meetings in September. Rate decisions or policy shifts at this time can shake global markets, providing a catalyst that lines up with the seasonal weakness. In previous cycles, those meetings have landed right inside the 2-week correction window, amplifying the volatility. The combination of portfolio rebalancing, investor psychology, and macro catalysts explains why September crashes keep repeating. Each factor alone might cause turbulence, but together they create the exact setup for sudden and severe corrections. Now that we know why the pattern exists, the next step is to look at what it means for this year and how 2025 could fit into the same cycle. With the history clear, let's focus on where we are right now in 2025. Bitcoin has already logged 5 straight months of gains, pushing momentum higher into late summer. This kind of sustained run looks almost identical to what happened before every past September correction. In 2013, August ended strong and the crash followed immediately. In 2017, momentum peaked on September 2nd, followed by the largest drawdown of that cycle. In 2021, the top came a few days later, but the same 2-week flush happened. All signs suggest that if history is going to rhyme again, September 2025 is the danger window. The scale of the drop matters. Based on past cycles, a correction could cut 20% to 40% off Bitcoin's price within 2 weeks. If Bitcoin faces that level of drawdown, altcoins could easily lose 30% to 50% in the same period. For anyone trading with leverage, that would be devastating. Yet just as history shows sharp corrections, it also shows fast recoveries. After every September crash, Bitcoin stabilized, then rallied to new highs within weeks. This is why 2025 could follow the same pattern. If August closes strong, the odds of a September flush grow higher. For traders, that means caution. For long-term holders, it could be the final opportunity to accumulate before Bitcoin's next massive move. The only question is whether you're ready to act when volatility spikes. Understanding the setup is important, but the real edge comes from having a plan for how to respond. Knowing the pattern is one thing, turning it into an actionable strategy is what separates disciplined investors from those who get wiped out. The lessons from 2013, 2017, and 2021 are simple. September corrections come quickly, they cut deep, but they don't last long. The pain usually runs for about 2 weeks before the market stabilizes and moves higher. That gives you 2 clear options. If you are sitting on profits after this summer's rally, you can step aside in late August, protect gains, and wait until mid-September to re-enter. If you are looking to build long-term positions, you can prepare to buy when the correction flushes out weak hands. Either path requires discipline because the volatility will be intense and the headlines will scream panic. For me, defense is the smarter approach. In a year where Bitcoin is already moving higher, missing 2 weeks of exposure is not nearly as risky as riding through a potential 30% drop. If history rhymes, the Federal Reserve's September meeting could even align with the correction's end, setting it for a stronger rally into the final quarter. That makes the timing worth respecting. No strategy is perfect and no outcome is guaranteed, but ignoring the September curse has never worked well for Bitcoin investors in a post-halving year. This is the window where overconfidence is punished and preparation is rewarded. And with that, we've broken down the full picture. 3 cycles of bloody September corrections, the reasons behind them, and the steps you can take to navigate what could be the next one in 2025. September correction is not the end of the cycle, and it could be the setup for Bitcoin's biggest rally. So staying prepared now matters more than ever. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.